Hey, multifamily buyers, if you purchased an apartment building in the last 24 months and you're looking to refinance out into CMHC, you need to listen to this.
We think it's important that you guys know what is happening with CMHC and some of the new regulations and rules that they're passing down that could affect your ability to be able to restructure, refinance your projects that either you're looking to take on or that you're looking to reposition in the current state.
What CMHC is potentially considering, and it's not concrete yet, but there is a lot of talk surrounding it, is a potential 24-month stability, taking a look at two potential timelines.
This is a major challenge that the industry is going to be facing currently, and there's a lot of Hey guys, Josh and Ehren back for another Finance Friday. In today's video, we're going to talk about something that we talk about often, which is CMHC financing. As markets shift, we like to bring you guys the most up-to-date information, and we think it's important that you guys know what is happening with CMHC and some of the new regulations and rules that they're passing down that could affect your ability to be able to restructure, refinance your projects that either you're looking to take on or that you're looking to reposition in the current state.
One of the things we're hearing from CMHC right now is some possible changes to their policies regarding refinancing out of a repositioning loan. So if you're unfamiliar with a repositioning loan, when you're purchasing commercial assets, the majority of the time these buildings aren't stable when they're being purchased. They need to have some renovations done, they need rental income increased, and some potential expenses decreased if you're looking to do any sort of energy efficiency pathway. What CMHC is potentially considering, and it's not concrete yet, but there is a lot of talk surrounding it, is a potential 24-month stability, taking a look at two potential timelines, either from the date of purchase or if you're in a repositioning loan that involves some sort of renovation loan on the side from the last draw. So for example, if you have a 12-month term and your last renovation draw is on month 10, your 24-month timeline starts from that month 10, not from the date of purchase. And again, these are potential considerations. We're not 100% dialed in yet, but it is going to create some issues moving forwards and some new pathways and thoughts for considerations from multifamily investors. Right now, repositioning loans are somewhere around 9 to 9.75% interest only, depending on the lender. So it is a higher interest debt. So if you're in a repositioning loan at that 9.5%, and then you have to continue to sit in that loan for what could be anywhere from like 3 to 4 years, depending on how long that initial term was and what the specific guidelines are coming from CMHC, it's going to change the debt servicing and how a lot of multifamily asset owners are going to want to, how many of them are going to want to continue to sit in this high interest debt for that long of a period of time.
And when you're looking at where we're at with the rates, even for conventional lending, even if you did stabilize your building and you were looking to refinance out, you might be able to pay out the private debt, but it's important to realize that you need to be in an HSA approved lender to be able to move out into CMHC. So, leaving the amount of capital you're about to have stuck in your deal or the additional refinance to be able to pull out some of your invested capital, this is going to cause some challenges, especially for people who are in the middle of projects or are looking at the viability of a project long term. Even if you have a stabilized rent roll and you have high interest debt, you're probably not cash flowing, which means it's going to take a lot longer and it's probably going to push out the small cap investors from getting into the market.
Yeah, I think it puts a lot of pressure on the smaller guy. Obviously, smaller, to mid-level investors don't have the free capital available to be able to carry the deficit of these higher interest loans over 2 to 3 years extra on top of that negative debt servicing that they're going to have to begin with. And that's, I think, something that you got to realize too, is that in that first 2 years of stabilizing the property, it's not like the property's carrying itself. It's a negative cash flow that borrower has to take on from their own capital. So not only are they, significantly in the red for those first 2 years, they could still be in the red for the 2 years afterwards, or just breaking even for those 2 years. So it is going to put a lot of pressure on the middle guys. It might see a shift to more buildings being purchased from a REIT perspective, but that's something that we'll just have to see as to, does CMHC come out and cement this, or, do they kind of start to realize how much pressure it's going to put on the market, and maybe they pull back on their policy.
Yeah, we've had a few conversations with some of the lenders that we deal with that specifically focus on repositioning loans, that are focusing on private capital and deploying it. Now, their entire business model is based off of helping people acquire underperforming assets, giving them some capital to make it a better asset, increase the net operating income, and then the exit is restructure out into something more conventional. And if they're anticipating 12 to 18 months for a project to be finished, and now you're 4 years, what does that do with recirculating their investment capital, because they have a return to their clients? Does it push people out? Does it start? Does it? Do you have to add an additional refinance after that? It's a whole lot of unknowns here. What we do know is that there are a handful of people who are going to be speaking to CMHC about what this looks like, because we're talking about billions of dollars in active deals right now in Ontario that are in the middle of restructuring and being repositioned. So this is a major challenge that the industry is going to be facing currently, and there's a lot of chatter about it. Hopefully, there can be some constructive conversations between the lenders and CMHC about what this would do to creating new units. We're in a rental housing crisis at the moment. We don't have the ability to be able to build the required units needed to be able to support the population of our province and of our country. So at what point does it not make sense to stop the people who are creating solid rental units for the population? We can't mobilize fast enough, and the policy isn't going to allow people and developers to build fast enough to be able to actually support the issue that we're having. So hopefully, better heads can prevail, and the lenders can have conversations with CMHC about trying to find a way to help create more. Now, if they can't, possibly we see a shift to people just building and developing brand new real estate, because if you can't recirculate your capital and you can't create a return, it makes more sense just to allocate a small amount more capital to building brand new. And then what does that do for affordable units? No one's building affordable units, because if you can't build affordable units, the cost to build is too high to be able to support the debt at the moment to do this. So it's an interesting situation, and hopefully our lenders will be able to find a way to be able to navigate this. We do anticipate, obviously, there are some ways to do this. There are lenders that have lower debt service coverage ratios, that are banks that we could transition out of, that are HSA approved. So there will always be a way to be able to navigate the current lending climate, but we're just gonna have to wait and see. We did think this was really important. And if you guys are wondering how this essentially came to be, if you take a look at the left hand isn't talking to the right hand. So the left hand, is looking for affordable units. Cash for keys is something that is part of this industry, and tenant incentives. And I think the government's just trying to get away from that. And what they see is, funding that type of thing doesn't necessarily fall in line with policies of the current government. And they're trying to find a way to be able to mitigate both while still funding multifamily real estate. But if we have a government that's going to continue to push the need for rental housing, this is going to be one step or two steps backwards in an entire market that is trying to step forward. So hopefully we can come to a conclusion.
On a more positive note, CMHC did come out and say that they are going to be increasing their fund allocation by $20 billion. So hopefully this helps to spur some of the lending products, and bring on some more lenders into the market as well too, which will provide a bit more of a range of scope of products, touching base on what we just took a look at in terms of repositioning and potential options. With the CMHC approved lenders, obviously we're limited with who can be accepted and who we can go to. If we do increase the funding, hopefully maybe a few more lenders come to the table, and that we'll provide a few more options for individuals in that repositioning loan situation, and maybe make that a little bit more feasible and a little bit more easy to navigate.
Yeah, in a market like this where you have 7.5% commercial debt, it's really difficult to make numbers work. So I think that the government sees that this is probably one of the more viable options for most developers, most investors, and they're going to continue down this path. If they're increasing their allocation this year, I assume they're going to continue to increase it as it becomes more popular, as we're in this high interest rate environment. Things weren't like this 2 years ago, 3 years ago, when regular fixed rates with institutional lenders were at 4%, 3.5%, all the numbers worked. So the longer we're in this interest rate environment, I think the more popular CMHC is going to become, and it's just the most viable option in the market at the moment. So I continue to see the government probably continuing to push this type of low interest debt for really good properties as we continue to go down this road. Now, when it comes to government rhetoric and what's happening, the government is trying to do a little bit. The new GST rebate did come back, which saves a current developer about 5% on the back end of their project. There is, I think, some talk about the provincial side also matching it, but I don't know if that's confirmed yet. But 5% seems like a little bit to people who are listening, but it's a lot when you're looking at massive projects. And when you have the increased cost of capital, you have the increased cost of actual goods and services. It's a great step in the right direction for brand new development. And I foresee that CMHC construction, if they keep putting barriers into buying and repositioning purpose-built multifamily, we're probably going to move to seeing people take their capital out of that type of investment and move it into brand new purpose-built construction. And there is a barrier to it. You're probably around that $10 million mark for construction, but in 2024, I probably see construction becoming the new hot topic.
Yeah, it's the allocations for purpose-built rentals, just in case it wasn't obvious. So, and I think, it's pretty evident that the government, when we're taking a look at, incentives and who they're focusing on, it is on the bigger guys. It's on the bigger developers that are building, hundreds of units, hundreds of millions of dollars per year. They're not, as focused on these smaller to mid-level investors and developers. It's up to you guys to be able to get yourself to this larger level, and it's going to take creative financing and finding JV partners and bringing on private capital to kind of help to get you there. But these incentives that they're putting out, they're not focusing on the smaller investors and the mid-level guys, where I think they should be, as we're starting to see the big developers. They're living on the margins. When interest rates are high, they're not going to be as active to build. They didn't become billion-dollar families and billion-dollar corporations by building on really small margins. So I think the onus of development is going to get shunted down a little bit more towards these mid-level to getting into the higher end developers, and it would be nice to start to see some products and incentives that might help to push the middle guys and not so much just kind of benefit on the larger developers.
Yeah, hopefully we can see some movement on some positive legislation or regulation being pushed towards helping the mid to small developer or buyer move into it, because these projects aren't cheap. Even like a mid-sized, small-sized multifamily, you're looking at about $1 million for a project, and that capital, we start to figure out what it costs to build. Buying a piece of land, 50% down, and then 20-30% in cash to be able to start the construction. If you added a little bit more money, you could probably build. So you're gonna have to incentivize people to take on these buildings. And if you take a look around at these cities, they're all 70s built, 3-story, 4-story walk-up buildings. What's going to happen when there's no incentive to purchase these? You need people in the market to be able to acquire these assets. And there's a massive generation of people who are letting go of them at the moment. So it might get a little bit more difficult, or you might have to find a different solution to be able to acquire and reposition these products. And Ehren and I are working really closely on finding ways as the market changes to help you guys continue to purchase and develop these. It's not like we're all just going to stop tomorrow and not buy these things. They still are cash flowing, compounding assets that are imperative to generational wealth. So we are working hard with our private lenders, our regular lenders, and our banks to find creative solutions in a market that's always changing. So we really appreciate you watching. If you have any questions about this video, please reach out to Ehren or myself. You can reach out to us on Instagram. You can reach out to us personally. Our phone numbers are down below. If you did like this video, we'd really appreciate if you hit the like button, hit the subscribe button. It allows us to create more content like this for you. Really appreciate everybody tuning in today.